one of the last ones for 2024. So this week's I called Black Eye Friday in an homage to the mad evening that is the last Friday before Christmas, with a little play on words on Black Friday, of course, as well, and a little bit of a play on words on Black Wednesday and other days like that, simply because of how well or not the economic performance in the UK is going. But there we go. So for those who have listened before, you'll know I like to start with a quote, and this week's is madness, madness, they call it madness. It's plain to see, that is what they mean to me. Madness, madness, they call it gladness. And that's from Madness, the famous UK ska band from the 70s and 80s. So before I get started in earnest, I must urge you once more to buy those tickets for the next Property Business Workshop. It'll be on us before we know it, Thursday the 16th of January 2025, with my business partner Rod Turner and I, this time around covering productivity, planning and financial accounting and bookkeeping. Why? Well, because we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping and making the same mistakes time and time again. This is to help get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or financial controller. Set it up correctly once and then just iterate from there. As always, it will be an action-packed, content-filled day which will stand alone in helping to advance your understanding as a property business owner. And early bird tickets with a 10+% discount are live at bit.ly/PBWFIVE. So welcome to the supplement. One more week where we wait for the next instalment of the English Housing Survey in the deep dive, because we've had a UK Bank of England monetary policy meeting and an ONS private rent and house prices report, which we've just got to tuck into with priority. As I've previously confirmed, the auction traders have finished a miserable December, while Mr. One-Way Traffic over here continued the relative ease with which units could be acquired. As always, no matter how loud I bang that drum, December bore fruit right until most people's final trading day, Friday the 20th. Mad Friday, Black Eye Friday, call it what you will. We managed to snag a couple of deals on Friday afternoon, while most of the world looked the other way or concentrated on something else. Don't say I didn't tell you. Anyway, onwards, enough navel gazing. Our weekly diet continues. Chris Watkin, stats guru, asked himself that question one more time before we break for Christmas. What is currently happening in the UK property market? Well, listings pressed the brake pedal, of course, a little harder, to 17,000 last week, and this is the week ending the 15th of December. And that's only to be expected, of course, only the really motivated list in December, as I've said before. They normally get told to wait until Boxing Day or the New Year. There's 1.687 million houses been listed this year in the UK, so we will get over that 1.7 with 2 reporting weeks to go, even if one of those weeks, of course, is very slow. Price reductions, measured by percentage, actually calmed down a little after the budget, 11.1% reduced in November compared to the long-term average of 10.6, but 13 for October and 14 for September. Stock levels are dropping rather than reductions, so we do need to be a bit careful in comparing these figures to the rest of the year. There were, however, 10,318 price changes in week 50, which is much more than the 3 years prior. There were only about 6,377 on average in the 3 years prior. The average price of the stock that did change its price was also £353,466. And that's much cheaper than the last 3 years, where it's ranged between 389,500 and 358,300. 19,100 homes sold subject to contract, a really good number. Perhaps the looming stamp bumps have kept things higher than usual, far higher than 2023, 21% higher for the same week. And we're even further ahead of the pre-COVID averages than we have been now, 9.1% above the average 2017 to 2019 year to date. Fall through stayed well under control. Forget those budget effects now. The fall through was 40% for 2 months after the Truss Kwarteng mess of 2022, and the 7-year average is 24.2 compared to 25.1 for the week. The market has accepted the changes and is keeping calm and carrying on at this time, hovering around the long-term average mark. Net sales still look healthy, 14,300 this week. A solid print on the year, 43% above the same week in 2022 and 17.5% higher than the same week last year. The relative health of the market is still very good, and that much should be clear. The stamp bumps are more widely being talked about in the wider media as well, finally. And we will see and watch out for the effects in the reintroduction of the 2% band starting at 125,000 up to 250, and the 5% band from 300k to 425k for first-time buyers. My view remains the same. Don't get involved in the scrum, stick to your guns, negotiate hard after April the 1st. Does that seem counterintuitive? Well, of course it does, but if you do the same as everybody else, get the same results. And you've just got to double that discount you're asking for on the basis of the extra transaction cost. So if it costs 1% more, take 2% off. Trust me, I've done this before. A tip about sales as well: if you're listing anything and are going on Boxing Day, make sure the actual estate agency office is open and taking inquiries that day. Otherwise, just list in the first week of January once the kids are back at school. On the investment side, as per the intro, I'm seeing and hearing more and more tumbleweed for the vendors now right up until Christmas. Keep calm, keep trading. Traders are doing well with their purchases, but poorly with their sales. Stay keen, keep your eyes open. There's bargains out there and a ton of lotted stock that isn't even being viewed, let alone offered on, that's getting pulled. If it didn't get offered at auction, it doesn't mean you can't offer on it. This still goes for Monday the 23rd of December. Not everyone is off work, 2 hours work could be very effective indeed. But this window of opportunity won't last long, but press your advantages if you're buying. Auction primarily is where I'm seeing that, but that's a big focus of our operation. Open market won't be much different. Most traded stock starts its life on the open market, remember. Plenty are still pulling stock because the market is so limp and expectations are not being managed. They're overvalued. They won't take the interminable multiple chips to get down to a saleable price. Prices at the aggregate open market level do look very reasonable though, when you look at all of Chris Watkins' stats for the week. So as far as the real time goes, we've only got 2 weeks left to report on now for 2024. One of those that will really be quite flat and boring indeed. But that means it must be macro time. So this is the meat week of the month, with the Flash PMIs brought forward because of Christmas, the labour market report, which might need a little pinch of salt alongside it, but who knows, the ONS certainly don't, and then the inflation report, which surprised no one, but generated plenty of headlines, many of which were politically motivated. No surprises in the latter, but at least allow me to gloat for telling you exactly what was going to happen with inflation this year and calling it nearly perfectly throughout, please. Then, we go out as we came in after a tricky and trappy week in the gilts and swaps market. Let's get on with it. Flash PMIs. We've had a raft of headlines about Labour freezing the economy, which is evidently correct at this time. Every piece of economic performance since and including July has been rubbish. From months of 0.2 and 0.3% growth prints, we've reverted to 0.0%, and even the last couple of months being backwards, minus 0.1% each at the current best estimates. The expectations were for a disappointing but only just positive print. 50.7 was the prediction for the composite, which actually flashed at 50.5. But the drag was once again manufacturing, which has continued to crater downwards. The expectation was 48.2, but the print was down to 47.3. Services printed 51.4 instead of the expected 51, and that's up from 50.8 last month. So they seem to somehow be rumbling forward like a wounded wildebeest, as they so often do. The straplines from the S&P Global PMI report: fastest decline in UK private sector employment for nearly 4 years, despite marginal upturn in output. That's not going to cheer anyone up, is it? Softer demand, rising employment costs and squeezed margins contributed to a further reduction in private sector headcounts at the end of 2024. The primary makeup of employment decline is the non-replacement of voluntary leavers at this time, which is fairly typical before voluntary redundancy and then active job cuts actually kick in. The chief business economist spoke of a triple whammy of gloomy news in the close to 2024. Growth stalled, employment slumping, inflation back on the rise, momentum gone, business confidence at a 2-year low, sales outlooks miserable, employment in December falling at the fastest rate since the global financial crisis in 2009, as long as you exclude the pandemic from the figures, which it makes sense to do. The final thoughts of said chief business economist are that the hints are that worse is yet to come as we head into the new year. His final parting shot was that he expects policymakers to be cautious about cutting interest rates going forward, given the resurgence of inflation. Yuck. Just to put this alongside the most recent jobs report, which is also from S&P Global, which actually discusses November, the 12th till the 25th, the same message came out from that KPMG Rec UK jobs report. There's a steep reduction in permanent staff placements, but the decline in the temporary market has eased a little bit. So what about jobs? What did the ONS say this week? Overall, it was a bit of a surprise. Unemployment stayed still, in spite of getting quite a few more inactive people back to activity. This means that overall, those that came back into the workforce were balanced out by those going into jobs. They're not the same people, but they're the same numbers, and therefore unemployment remained at 4.3. And please bear in mind this is October's unemployment figure, and the PMI reports we've just been discussing are more real time. But also bear in mind how October apparently showed minus 0.1% growth, and it was an economy paralysed by budget fear anyway. That inactivity rate, not long ago above 22%, has clipped back to 21.7, which overall is good news for the economy. 74.9% employed is also back near where we want to be, in the above 75% range, and into the 76+% range ideally. Vacancies are down for the 29th consecutive period. 818,000 is still plenty, particularly by historical standards, and still represents a pretty tight labour market. Still, the trend was a bit sharp for most, budget driven. The vacancy data is including November, confusingly enough. Also, without many of the commentators noticing, the pandemic one-offs have now dropped out the figures, bringing wages including bonus back into line with wages excluding bonus. For no good reason, apart from the fact that 99% of the reporting in this space is lazy, the including bonus figures are the ones that always get quoted, even though there had been this base effect distortion. I've been saying for over 12 months that we needed to be concentrating on X bonus, and now there's been a surprise print that isn't a surprise at all. It's all very frustrating really, but either way, the figures on that front are simply now accurate again rather than respective, but it's not a surprise at all. I noted earlier this year that the expectations of businesses for the year was around a 5% pay increase, or just over. I think they were at about 5.5% on the Bank of England surveys, and once again, business has got that right. So that left annual growth in real terms, adjusted for CPIH, which is running higher than CPI, at 2.2% in real wages, which is very acceptable and a lovely number to try and hit for an economy every year. We still lost 42,000 days to labour disputes in October 2024 as well. So the ONS in their report, as they have since the pandemic, pointed out that all the figures could be wrong. Fewer people are answering the survey apart from anything else. So 173,000 extra employed people, roughly the same number as those that came off the inactive list, as I said, was a miss of 185,000 jobs on the consensus figure. That's a really large number of jobs in the UK job market. It's a miss as wide as a country mile. This, alongside the surprise in average earnings including bonus, meant that the gilt yields very much hardened on this report overall. The message is, pay rises still too high, which is potentially inflationary, and no jobs crisis yet at all, in spite of what we're hearing in the PMI reports. But as I say, remember those PMI reports were for December. So from employment to inflation, and I've got to start this section with a bit of a vent or a rant, I'm afraid. It's clearly been a long old year. In seriousness though, let's start with a selection of facts that can't really be in dispute. Labour, since entering government, have made a mixture of mistakes and policy decisions which have directly led to the withdrawal of growth from the UK economy. From the first 2 quarters of this year registering plus 0.7% and plus 0.5% growth respectively, which are great figures in the present day. Figures we would aspire to as an economy, a mature industrial economy. And then we had a quarter registering 0.0 and one that at this time looks like it will register somewhere between minus 0.2 and 0. When you look back, as I stated at the time, the true test was for a couple of years just keeping pace with the rampant inflation rate. Indeed, the economy couldn't, printing that negative growth figure in real terms for Q3 and Q4 2023, entering a technical recession. So let's not praise the last lot too vigorously, because the same team was still in charge. Although it might be fair to say they were mopping up after the utter incompetence of their predecessors, who were from the same party but not the same planet. What really happened in the first half of 2024 on one framing of it was simply that inflation came back under control, which meant nominal GDP growth that had either just about kept pace with inflation or just fallen short, stayed high, and then it was adjusted by a much lower figure for CPI, and that then translated into real growth. So you might need to listen to that bit more than once to make sense of it, but that's the best way I can think of to explain the phenomenon. So what I'm saying is if nominal GDP growth was 4.5%, then if inflation was 5, the economy would shrink in real terms. So GDP, as we normally talk about it, real GDP, would have been negative. But with inflation at 2.5 and nominal growth at 4.5, it's suddenly a healthy looking growth rate. And it's easy for us to forget about this because we always talk about GDP as GDP. We don't emphasise the fact that it's been adjusted for inflation already. It's the default position. So, what about inflation itself? We had a truly distorting effect on an already high CPI from the energy price spikes of 2021 to early 2023. It overshot, with energy prices up more than 1,000% in terms of their wholesale price. And then it shot right back down as the world reacted and normalised by quickly ensuring more LNG was available from other less hostile sources, aside from anything else. Thus, we had this one-off drop in inflation simply because of the way these things are calculated as soon as that dropped out of the figures. And that was highlighted a number of times, not just by me, but by the Bank of England, amongst plenty of other organisations. It was very clear that inflation would fall and then rise again. I've spoken of it a whole number of times. I've also, on a monthly basis, discussed why I look at the core inflation figures, not just the headline CPI figure. Thus, none of this tick back up in inflation is a surprise or anything like that. A small amount of it can be put down to the budget, for example, but in honesty, that's a very small part of it at this time. I've been amongst the first and the largest critics of the approach of picking the pocket of the people by the back door, breaking manifesto promises, such as not raising national insurance, that never should have been made in the first place, and the likes. But let's please call it like it is. Okay, breathe. If you missed it, the broader consensus was that CPI would hit 2.6 for November in the figures released this week, and that's exactly what happened. Most commentators, me included, had inflation at somewhere near 2.75 for the final quarter of 2024 if we went back a whole number of months. So this isn't a terrible number. As so often, the direction of travel is the concern and what's causing the navel gazing. But this was a guaranteed tick back up from a false low. It's no more or less than that. So as I say, we're better off to look at core inflation year on year. And that's why I chose it as this week's graph. So if you check this out on my LinkedIn or on the Partners in Property blog, you'll find this week's graph, core inflation over the last decade or more. And it's been steady as anything really since May, hasn't moved a lot, but it's steady around 3.5%, which is a rate that I've been suggesting is much more accurate than headline CPI, and also a rate that much more reflects a relatively near-term pandemic period when you look back historically. I also have in my contact book some helpful and insightful messages sent to me on a weekly basis. One came this week from a contact who is a commercial director of an SME. They messaged me on the back of a LinkedIn post where I'd referred to inflation. Here's what they said. They work in the wholesale food sector. I saw what you said in the supplement about inflation on food, and I thought I might give you a view based on my experience. Every supplier is now out looking for 3 to 4% CPI effective from April. This is in addition to the input inflation coming from our suppliers. This is likely to be another 3% plus, which will flow through over the course of the year. Branded suppliers, people like Heinz, generally look to significantly over-recover on input costs, so likely they'll go much higher. Given there's precedent of retailers using inflation as a lever to margin up, and the fact that they'll have a lot of their own labour and national insurance challenges, there'll be no option but for this to flow through into retails. In my opinion, around 5 to 7%, depending on category, looks reasonable and realistic. Not ideal for the already stressed consumer. And look, food is a seriously competitive area where price rises are beaten down throughout the supply chain, but also it has to be sensitive to shocks that involve the cost of employing people increasing massively, because a lot of people are involved in said supply chain. Production, packaging and the likes, very sensitive to changes in the minimum wage. Keep pushing minimum, keep pushing those prices up. I'm grateful for the input, assuming the source is reading or listening. Thank you, nothing like coalface insights. The ONS, of course, stick to CPIH as their front-end poster boy metric for their reporting. That printed 3.5% for November. October's was 3.2%. But monthly, this didn't look too bad at 0.2% month on month. Core CPI moved 0% month on month, and RPI moved only 0.1% month on month. A flat economy, a flat month-on-month figure, short of external pressures, some might suggest. It's certainly congruent with the retail and real-time analysis of November that we've already done. In the words of the ONS, the largest upward contribution to the monthly change in both CPIH and CPI annual rates came from transport, with a further larger upward in CPIH from housing and household services. OOH, as those who are regulars know that I like to keep a close eye on, hit yet one more fresh high, moving from 7.4 in October to 7.8 in November. This is the owner-occupier measure of housing costs, right? It's another higher high with no definitive sign that this is the peak. It is a synthetic measure, which is often criticised, but it does reflect 2/3 of the households in the UK. It's a frightening figure, really, and it gets no headlines whatsoever. But in reality, it just looks like what CPI or CPIH did about 3 years ago. We've still got to find that top. The month-on-month for OOH was 0.8% up, a terrible run rate. If you think of OOH as the metric that explains the difference between CPI and CPIH, which is 2.6 to 3.5, that's a good enough understanding of it. Core CPIH moved from 4.1 in October to 4.4 for November, in another worrying sign of what true underlying inflation looks like in people's pockets. And this all adds up to the stretched consumer, as referred to above, not noticing much of a change in fortunes, even if they receive a 5% plus pay rise. Services inflation, a massively important part of the numbers, stayed at 5% for CPI and ticked back up again to 5.7 on services CPIH. Still a big concerning number, and one that keeps the base rate right up there in the 4+ range on a very much justified basis. Even at the false flag level, frankly, of 2.6% CPI, UK inflation is still well ahead of France at 1.7, ahead of Germany at 2.4. Both of those have got significant issues of their own at this time, and also the US figure of 2.3%. Goods inflation also went positive month on month after 7 negative months, where the much higher energy prices dropped out of the mix apart from anything else. But in summary, not a lot to be cheery about. A more accurate rate would be around 3% or slightly above if we were discussing what is inflation in the UK economy right now. And the direction of travel is definitely reverting upwards. As I've been saying for over a year now, the new world rate is 3%, and anyone not recognising that is kidding themselves. But coming out and saying it would upset the already fragile bond markets, who are already losing their faith that the 2% target is really being adhered to. I'll close this section with one more point of fact. What was inflation in the 2010s? A decade with minimal disruption. The 2 points of note really being in 2011, when the phrase double dip recession was the one that forecasters were mooting. Around 5% CPI we went to. 5.2 if I remember correctly in February 2011. And then 2016, post-referendum, when the markets experienced a shock to sterling overnight after a shock result in said referendum, and inflation once again topped 4%. The average over the entire decade for CPI, 2.7%. Don't tell me we're going to print under 3% average for the 2020s, and surely we'll be over 3.5%. There's just no chance of being under 3 unless there's enough catalysts for a depression. But the word that has surfaced again in a couple of weeks after being wheeled out a couple of times over this cycle is stagflation. Now, it's not the most crisp to define, but suffice to say it definitely includes low or no growth, so we can check that one. Inflation above target, so we can check that one. And traditionally includes high unemployment. Now, we're not checking that one yet, but what would high unemployment look like these days? It would have to be above 5%, and really above 5.5%, I'd suggest. But less than a decade ago, under 6% unemployment was heralded as a sign of healthy economy. Not easy. So, we can move into the weekly gilts and swaps summary. It was a wobbly week. We opened at 4.225. We tested 4.45 on Thursday, nearly tested the 52-week high on the gilt yield, after the market appeared to anticipate not only the rate hold, but also the vote at 6-3 to hold the rate, a little bit firmer than anybody would have liked. But then the yields decayed right back in a very orderly fashion to close the week much closer to my target range at this time, closing at 4.283. It may well have been just the unwinding of positions in the lead up to Christmas. You can't rule anything out as the volumes start to ebb away significantly in the next couple of weeks. There's also been a really significant flattening of the yield curve. It really does look quite flat now for the first decade. And whether that is, as traditional, the calm before a recessionary storm, or just the fact that base rate has been a tad high but is now finding its level, as we seem to enter a world where 4 or even 4.25 base rate might be considered the norm? It's not clear. In spite of Labour's efforts driving everything but growth at this time, it doesn't appear self-evident that they're going to force us into a recession. On Thursday night, the 5-year swap closed at 4.023% yield, back above that psychological barrier. The gilt closed Thursday at 4.367, so that generous discount, 34 basis points, is still being preserved. And thank goodness, leaves our best guess for 5-year limited company fixed rate mortgages at 6%, and rule of thumb investment grade gross yield at 8.6% or thereabouts. Alright, scuba gear on as we segue from there to the deep dive. Firstly, the Bank of England. This meeting is the lesser exciting meeting of the quarter, doesn't get accompanied by a full inflation report. Indeed, this close to Christmas it normally falls out relatively quietly, although the 6-3 vote to hold did capture some attention and inspire a bit of activity in the gilt markets, as I've already said. The 3 who voted to cut the rate voted to cut to 4.5, which will likely be the result in February when the committee next meets, although I've got this as a greater than 50% scenario, but nowhere near a penalty kick, to be clear. We've got another month of inflation figures out before then, but only one. The bank had themselves expected 2.75% inflation in or around the end of 2024, which does look accurate. But they spent enough years recently not being accurate at all with their forecasting. But as things have calmed down, of course it does become a lot easier. They also choose their words carefully, but the next paragraph is very difficult to disagree with, so I've repeated it in its entirety. Most indicators of UK near-term activity have declined. Bank staff expect GDP growth to have been weaker at the end of the year than projected in the November monetary policy report. The committee now judges that the labour market is broadly in balance. Now, interestingly, that's not congruent with what I said earlier on in terms of it's still looking relatively tight from a vacancies perspective, but the Monetary Policy Committee think that it's broadly in balance. That could see unemployment going upwards apart from anything else. Annual private sector regular average weekly earnings growth picked up quite sharply in the 3 months to October, but that has tended to be more volatile than other wage indicators. The latest agents' intelligence suggests that average pay settlements in 2025 will be within a range of 3 to 4%. There remains significant uncertainty around developments in the labour market. Now, I just want to dwell on that 3 to 4% because I do like using, so bear in mind, what do the agents do, right? They gather data from regional businesses. So the West Midlands has its own rep. There are various reps around the country. They were very accurate this year when they said it would be about 5.5. It's ended up ending about 5.25. So usually very good. But the reason why I want to dwell on that is the next natural progression would have been to 3 or 4%. But I'm not sure that everyone's really factoring in all of the national insurance rises yet. Because apart from anything else, that's going to put prices up. If you're employing minimum wage staff, the cost of employing them, assuming you lose their employment allowance because you've got a slightly larger operation, with all the changes in the budget, is 10.75%, right? These costs are going to have to be recovered from somewhere. And I wouldn't be surprised if actually we see a little bit of a lull in wages and we're closer to that sort of 3% end of the range, or maybe even below it. But whether that's a permanent trend or just something to a shock absorber for the changes that have come in thanks to the budget, we're not really sure. Those changes are coming in obviously for the next tax year. So I trust this forecast for wage growth from the regional agents much more than I do in terms of what anybody else is saying or forecasting realistically. I think it's a good temperature taker of a nationwide businesses, those who employ people ultimately. But if you put together, 2 and 2 here, ultimately, massive increase in cost of employment, forced into minimum wage side of things. Also, I believe inflation is going to be, it should be in the 3% region, pays in the 3% region, inflation's in the 3% region. Where does that leave us? Real household disposable income not going anywhere and potentially going backwards for quite a few people. But interestingly, not in the sector who are full-time minimum wage earners. Particularly you've got 2 people in a household who are both full-time minimum wage earners. They'll be okay as long as they can keep their jobs, as I've been saying, apart from anything else. Nothing in terms of the bank's outlook really changed. The budget's changed a few things and they're watching them all unfold relatively slowly and carefully. This is what they do. They're central bankers ultimately. But their policy of little cuts, slowly and steadily, which has been their stated policy throughout 2024, has not changed. and there's nothing really to suggest it should change at this time. R star, which I speak of on occasion, remember that's the natural rate of interest, which means no growth or contraction that's forced by the base rate of interest, looks to me higher than it has done all year, as I say, at 4% or more, possibly 4.25. And the cutters, those two, the three people who voted to cut: Swati Dhingra, who votes to cut every single time, the largest dove on the committee; Dave Ramsden, who was the first to join Dhingra in voting towards a cut earlier this year; and then Alan Taylor, who's still relatively new on the MPC. And this gives us a bit of insight into his persuasion in general. More dovish than hawkish, we would expect from this vote. Perhaps an ally on the Monetary Policy Committee, folks. Overall, the bit the press wanted to hear is that the bank were blaming the Labour Party. That's not a fair reflection at all. There really is no argument that the budget hasn't significantly impacted growth prospects and expectations. It's not political, it's just a summary of the facts, and that's all that the governor did. Many might not like that summary of the facts because they are political, but that's their choice. That leaves the ONS private rents and house prices. Rents for November and prices for October. That's just how the reporting speed works here. There was a comparative surprise in a 9.1% print for rents for November 2024, a print going back upwards again, very close to the series high of 9.2, which was printed in March 2024. This won't work itself out particularly quickly and suggests even more pain for the tenant in 2025 than has been predicted. A 7% estimate for 2025 rent looks reasonable at this stage across the nation, and perhaps even more. The 9.1% broke back to 9.3 for England, and 8 in Wales, 6.5 in Scotland, and 9% in Northern Ireland. Northern Ireland figure is back from September. They're sorting that out in the new year, apparently, with some better reporting. London printed 11.6%. Eye-watering stuff on London rents. How much more can the London tenant afford? The cheapest rise was Yorkshire, only increasing by 5.7%. And then the house price print for October, a year-on-year rise of 3.4, which is a move up from 2.8 in September. My expectation is we still print over 4% for the year by the time we get to Feb 25 and we know what the December prices have done. And then we get that number for 2024 confirmed. There are still revisions to be done quite often. I also always like to sneak a difference at the look between the average price of a cash transaction versus a mortgaged one. That difference was 9% in October 2024. So that's £276,432 for the average cash transaction and £303,922 for the average mortgage transaction, in case you were wondering. As far as regional variation goes, London prices are up 0.2 on the year, according to the ONS, but 4.7 in the northeast, 4.6 in Yorkshire and the Humber, and 4.4 in the northwest. The Midlands average out at 3.8. This 9.3 print for England for rents is the England record high. It's the tapering downwards of the Scotland catch-up rent increases, thanks to their horrifically misguided rent cap policy, that contributed to keeping it down to 9.2% overall for the UK. When we break back to the regions, to keep it down to 9.1, which is 1.1 lower than the 9.2 that was printed in March. When we break back to the regions, it's an inverted graph compared to the capital growth chart. London's 11.6% rents, the area of the country where we're anecdotally hearing of the very most significant sell-off of rental stock, is the highest. The Northwest also does very well though, performing very strongly on both capital growth and rent growth. Rent growth is 10%. Either way, all the rents are above any of the other measures of inflation discussed today, wherever the tenant lives. What's the sustainability of these increases, you must be asking yourself? Well, you're going to have to consider what your tenant does, of course. 6.7% increase in minimum wage in April provides, after a 28% tax rate, a 4.8% increase in disposable income if the recipient was already earning over the personal allowance of £12,570. Put against the realistic in-pocket inflation rate of 3.5% or so means little or no improvement in the standard of living if 30% of that increase goes up by 7% or more. 30% roughly represents the rental cost in a household, as we've been learning over the past few weeks. It's not a major backpedal, however. It is workable. Expect more and more calls for rent controls on the back of this, though, however. I want to close this week with a summary of some of the polls I've been sharing on LinkedIn since the English Housing Survey 23-24 has been published. I've been stunned generally by just how far the results have been away from reality. Even with an engaged, educated and niche audience, it's clear that even many of my followers believe the media rhetoric that it is impossible to buy houses when you are young. They believe far few people own houses outright than they do, and the likes. I shared an article this week which was drawn from the survey, pointing out that people born between 91 and 95 are now slightly more likely to be homeowners by age 25 than those born a decade earlier. That's 14% versus 13%. My poll suggested that most believed the figure was closer to 1.4% than it was to 14%. This is all on the back of a Resolution Foundation report, which has gone into my pipeline for some analysis over the coming weeks. So just remember, don't believe the hype. You must look at the stats to get a true picture. The current direction of travel looks trappy, particularly for the tenant, but the past decade has not been terrible in those shoes. The anti-landlord government policy, alongside the relatively rapid normalisation of the interest rate, means that challenge faced for 2025 is one of the most significant thus far. The tenant desperately needs proactive representation who can engage with the real issues and get the messages that really need to be got across to government, but I doubt anyone's holding their breath. If they are, please don't. So, as you polish off your advent calendars, one more reminder that the tickets for the next Property Business Workshop are out. Thursday, January the 16th, 2025, with some great subject matter: planning, efficiencies, financial accounting and bookkeeping. Not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective, ongoing monthly basis. Come along, get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Get your Christmas present to yourself. Early bird tickets are available with a 10+% face value discount on them. Once they're gone, they're gone. These events do sell out. Rod and I hope to see you there. Buy one at bit.ly/PBWFIVE. And you know what I'm going to say next. There's only one way to deal with all of this ongoing noise and excitement in 2025. Keep calm, always read or listen to the supplement and carry on. Only one more left for 2024. Now, just before I close, I also wanted to say I'm considering doing a 12 video series over Christmas, a 12 days of Christmas, if you will. I'm going to do a short video every day based on questions that I get submitted to me. I've had a couple that I've saved up over the years, so that will cover the first couple of videos. I don't really want to be doing anything that's personal to yourself, unless it's going to add significant value to everyone who might listen to one of these videos. But if you do have any ideas about any particular concepts that you hear me talk about on a regular basis that you think need a better explanation or a more up-to-date explanation, or just any topic you'd like to hear me expand upon, let's keep it property and economics related, folks, please, then please will you just either leave me a comment on this video or send me a message via my LinkedIn, Adam Lawrence on LinkedIn. Thanks for listening. Looking forward to a great 2025. Take care, everyone. Keep calm and carry on. Thank you.